Hey, good morning, everyone. Welcome to the first day of trading in the fourth quarter of 2025. It's been an interesting year. Every year is interesting in stock investing, stock trading. And we are going to try to see what's going on, pick out a list of stocks that Daryl and I think are interesting to take a look at, but we welcome you to suggest stocks to analyze. And if you have been on the channel before, members, you can put a stock in there and we review it. It's part of your membership benefit. If you're not a member, no big deal. You buy a $5 super chat and then we'll take a look at your stock. And my colleague Daryl, how are you today? How are you doing this morning?
I'm doing wonderful. I'm struggling with my internet, but I think I may have it corrected now. So hopefully everything's good for the stream. Good to be
Yeah.
here. Welcome, everyone.
Yeah. The internet connection is now like oxygen. It's like,
Yeah,
geez,
exactly.
can't live without it. Um, yeah. So I think we've got a fairly interesting day ahead of us, and most definitely an interesting 3 months ahead of us. We've got the government shutdown that is happening. We are shut down on the US government. So I know that I'm going to call it not essential services and processes are not active, but people are still going to get their Medicare payments and that are, yeah, Social Security payments and things of that type. So that doesn't get disrupted, but other offices do get disrupted. We'll see how long it lasts. Hopefully it's a short shutdown and nothing really gets thrown out of whack. We also had ADP, which is a private payroll company, come out with their payroll report, and they showed that the economy lost 32,000 jobs, and it was expected that the economy was going to increase, um, you know, by 50,000 jobs. So it was a move in the opposite negative direction. So that is a fact or a data point that would lead economists to think, hey, maybe we're headed into a recession. And if we are, the Federal Reserve, I would think, is going to reduce interest rates. Um, Now, having a recession is bad for everybody, including stocks. So hopefully, if we're heading toward recession, we kind of pull ourselves out of it. If we do get into recession, it's not a bad one. But for sure, I'm expecting that the willingness to reduce rates is going to be there for the Fed, and we'll see how that plays out. All right, so it looks like we got Brushy, and you'd like to look at Remitly, and I'm going to put that on the list. But I've got three stocks ahead. We were going to open up with kind of it's going to be the Daryl playlist. There's three stocks that Daryl put and suggested, and I think we're ready to go with those. So hang tight, and we will go over Remitly. Got it on the list. Peter, good morning, sir. Thanks for the comments and the videos you've been posting on Discord, sir. All right, so just a quick glance at where we're at. We just completed 9 months of 2025. It's been a very good year. The S&P is up 13.7. That's a very good year-to-date number. The S&P historically, if it does 10%, it's good. 12%, great. Now it's been doing like 20, 25%, which is historically much better. So um, the we're kind of getting spoiled over the last 3 years. It's like, man, stocks are going really higher. Now, I want to reinforce the fact that retail investors, people who have decided, hey, I want to be more active in my investments, in managing my portfolio. I want to learn more. I want to do more. I want to become better. All those are being rewarded quite well. All those who bought into Nvidia, Palantir, Robinhood, mean, you're getting rewarded to say the least. And it's I think it's great. It's great for the retail investor to participate in the acceleration of each individual's net worth. If you are a passive investor, nothing against that, right? If somebody is out there, like I have a sister-in-law, the nicest person, one of the nicest persons in my life, and she school teacher, has been a school teacher. Um, she's got a good thing, so from a net worth perspective, but she's completely a passive investor, and I help her with her investments and so forth. I get that, and I don't think she'll ever be a active stock trader of any sorts. But then there's guys like me and Daryl, and probably you if you're on this live stream. We're more of the, hey, I want to go out and figure this out. I want to learn. I want to be a very good investor because first, it's super interesting. It's really a challenge. It's something that, I get out of bed and want to tap into. It's a big challenge. It's a lifelong endeavor too. And we don't play for fun. Speaking for myself, I'm betting substantial amounts here, and when it goes well, it goes well. There's big rewards involved. So I just want to reinforce that if you're active, if you're listening to this stream, if you're investing in yourself by learning and getting better, taking chances, learning from your wins, learning from your losses, congratulations and keep going. The market's not going to stop. It's just going to keep doing what it does. And I think you can keep expanding your net worth. So that's where we're at for the year. What's going to happen for the next 3 months? It's a guessing game. My guess is we're probably going to keep going where we're going. Like it's probably going to go higher, but that's just a guess. Nobody knows. When we look at the top, let's take a look at the most valuable stocks year to date. Nvidia, incredibly, is up 38.9% year to date. Broadcom, incredibly, 42. Palantir, 141. We've got just some high flying stocks, and you only have a couple red spots. Salesforce is down 29%. Adobe. So the software space is the market, the universe believes that some software companies are going to be hurt by the AI revolution. AI is going to create new methods of people doing what they do with Salesforce or ServiceNow or Adobe, and it's going to take revenues away from those companies. Now, I'm not in that camp, but I understand the logic. We'll see. We'll have to let that play out for the next couple of years and then really see, did these guys continue to grow? Did they contract? Because that's really what we're going to end up seeing is, did they contract or grow? We'll see what happens there. Uber's up nicely, 62%. It's been a quiet 62, by the way. Uber has been doubted. The whole Tesla is going to take, robo-taxi on and dominate it, even though they're really not even in first gear, so to speak. Our friends over at Google Alphabet, they're the ones that are leading the whole robo-taxi market. And Google has really had a nice 2-month run. Really glad to see that because Google is a really valuable business. Meta's doing what it does. Although lately it's been kind of stuck, going down a little bit. Amazon's a big surprise. And it's a surprise and it's an opportunity wrapped into one. I am buying Amazon stock because if the market wants to sell Amazon, I want to buy it because it's one of those, if I had to list, let's say 5 companies that are the most important, powerful companies with the best moats, Amazon's on that list. It's on many people's lists if you ask them for that. So if I believe that Amazon's going to be really, really important for the next 10 to 20 years, and the stock market's going to lower the price, I'd like some more shares, please. And I've been buying into Amazon quite a bit. The healthcare space, we'll see if it begins to work. I know that United Healthcare, this is a little deceiving because it really sold off. But if you look at the last 45 days, you're sitting on gains, because I know I'm sitting on gains with United Healthcare. That was a good opportunity within the year. J&J, we're going to look at J&J. That's going to be our first stock we're going to analyze. But look at that, 28.21. Johnson & Johnson, dividend payer in the healthcare space. We're going to take a look at that stock. We're also going to look at Qualcomm, and Qualcomm's up 8.29. It is lagging the S&P, pays a dividend. But we're going to take a look at Qualcomm, and then we're going to look at the big, powerful, awesome Nvidia. Just bow to what is the greatness of Nvidia, speaking for myself. All right, so that's where we're at there. And let's get going. Let's take a look at some stocks. Let's take a look at some stocks, starting with the list that Daryl had in mind. And Daryl, I'm going to let you kind of lead. And I think you're going to start with J&J.
Yeah.
Then I'm going to follow you and go over J&J's fundamentals.
Okay. So one of the interesting things about J&J that we put up on this chart at least 2 or 3 weeks ago is this breakout of a 3-year base. So basically from March of 2022 until July of this year, it traded in a range between 138 to 165 or so. So it basically traded sideways for 1, 2, 3, almost 4 years. Then all of a sudden we got this breakout, which I love to see. I've seen this on many charts. When you have a long base like this and then it breaks out, those are really, really powerful. So J&J since that time has run up from that 165 to currently 185 in just 2 months. So that breakout is pretty powerful. And then I want to note what my price target is. So beginning in 2025, we did start off on an upward trend. We peaked out, then we formed a cup with handle pattern. And I get my target by measuring down from the right side of the cup, which is about 167, down to 143. I get the difference between those two measurements, and then I add it to the value that I got on the right side of the cup, and that gets me the price target for J&J. So that's what I'm looking for at the moment.
So your price target's like 225 or so?
No, 193.
193
from here. Yeah. Let me see what J&J's seasonality is. So I'll go back 13 years. So they got about 1.6%, 69% of the time in October, 1.6 in November, 69% of the time, and 0.4% here. And then in January, they're flat. So the majority of the time they do, that's 3.2, 3.6. Possibly from here to the end of the year from a seasonality perspective. So I think J&J is still looking strong, and I wanted to make sure that I pointed out how powerful these basing patterns are, especially when it's 3.5 or 4 years long.
So your price target's 193.
Yep.
Funny. I'm looking at my valuation. My value per share is $193.20.
Yeah. Funny how that works out, huh?
Hilarious. Okay. Well,
so
I guess
that's one. And one of the reasons that I value technicals a little higher than a lot of people do is because these patterns occur over and over. Nvidia did this twice or 3 times over the last 5 years.
I have a comment when you got a second.
Sure, go ahead.
So, Johnson & Johnson had business problems. There's a reason why the stock was not flourishing. They had the talc lawsuits where people were suing because they were inhaling the talc and it was causing health problems. They got that taken care of. So in that time, this is the chart is covering some of those problems. So now that the problems are resolved, I could understand the breakout. Okay,
Yeah.
hey, J&J doesn't have a cloud of problems over it. It could now begin to kind of just operate their business, start growing their profits.
Yeah, that makes sense. We're just barely in overbought condition at this point, and accumulation is at a year. This is a 3-year chart, so this is a 3-year high on the accumulation. So that's what I wanted to look at for J&J.
All right. Can I look at the fundamentals?
Oh yeah, sure.
Yeah.
Then we'll go to Qualcomm.
All right. So when I look at the value of Johnson & Johnson, Johnson & Johnson is a very respected company. Their credit rating is really, really high. They've been around forever and they have a very stable business and they generate just gobs of cash. They're just a cash generating machine. And those cash flows are worth a lot of money. If you take the net present value, and I'm using a lower than typical discount rate because of their very high credit standing and the fact that interest rates are coming down. So 7.5 is probably going to be my new rate with very, very exceptionally good credit worthy companies. This company, once I discount the free cash flows that I expect in the future, which are not growing overly fast, but they're just so darn big, I get 553 billion. They have good cash on the balance sheet, an amount of debt, but not too high, well below 3 times debt to EBITDA. And we get $540 billion of value, but the market cap's 446. So there's a discount on cash of 17%. The earnings per share doesn't quite get me to their stock price now. I'm giving them a PE at 12 because they're not really growing. If you look at their growth, and I'm going to look at that next, they're not growing super fast. So it's like, well, how much am I willing to pay? So 12 is pretty modest, pretty conservative. And when I combine the two, I'm at a 4% discount. I think each share is worth $193 per share. The stock's trading at 185. The stock is probably for an older investor or an investor that doesn't want to take big risks. They just, you know what? I want to make an adequate return. Johnson & Johnson's a pretty good option. And when we look at more of their fundamentals, what do they have to offer the investor? Well, they start with offering the investor a 2.8% dividend. That's pretty good. That's pretty good dividend. Stability. They offer the investor stability. Very recognizable company, very well run company. I believe they run out of Cincinnati, Ohio, right? And no, in New Jersey. So they've been around for a long time. They have staple healthcare products, everything that you want in a company, in a healthcare company. And the stock has been doing well year to date, up 28%, the 1 year up 14.88. It hasn't been run up, very high over the 5 year. They've had their problems with, the whole lawsuits over the talc and so forth, but I think those are behind them. So things should get better. This is where, this is not going to excite those. Like we're going to look at Nvidia in a bit. And that's going to be exciting. It's going to be like, holy smokes, are those numbers real? They're so, so incredible. Well, these are not incredible. These are just growing a tiny bit, but they are growing. So that is good, consistent growth, which is good. Looking at the quarterly, that looks good. So this line is very acceptable because they are big, $90 billion of overall revenue. And when we look at their free cash flow, it looks real good. Really big, just powerhouse when it comes to cash flow. Margins look good. For a company their size, 68% is very good. Profit margin of 25%. This is just a very well-run business. And, the balance sheet's good. Analysts, 15 analysts. And we've got an analyst with a price target of 215, an analyst with 152, and right in the middle is 180, or I should say the average is 180, which means that the stock is fairly priced. I think we're all kind of in the same zone on J&J. I think Daryl's at 193 as a price target. I'm at 193. I can't argue with people that are a little lower. I can't argue with people that are a little higher. I think we're all in the same zone. Earnings per share is going to grow nicely, and revenue is going to continue to grow. So again, J&J is an investment for, somebody that wants a reliable company. It's not going to double in value or price in the next year or two. It's not going to be the next Palantir, the next Robinhood. That's not the outcome that I expect out of J&J. But it is going to be a stock that you wake up 10 years from now and it's worth more. It delivered a good rate of return. It was safe. If we have a substantial, sell-off like we did in 2022, where growth stocks were down 60%, technology growth stocks, J&J is going to look like a beautiful investment. It's going to look like, hey, in 2022, it did okay. Okay, it didn't do great. But if you look at let's say you look at Meta was down 85%. I mean, the market really took Meta out behind the woodshed. And it did that to a lot of stocks. And that's what happens in, big sell-offs, big corrections, and crashes on the market. So this guy here is a little bit of an insurance policy for the investor that wants to reduce risk. All right, so now I'm going to pivot and I'm going to go over Qualcomm. Is that the next one you wanted to cover?
Yeah, that works.
All right, so I'll introduce it and then I'm going to pass it over to Daryl to do the charts. Qualcomm is a semiconductor company, $178 billion in market cap. And they're doing well. I'm going to show you their growth and we'll get to that in a minute. Year to date, it's up 8%. 1 year, it's down 2%. 5 year, it's up 41%. So this company, I think the story on Qualcomm is what's holding back the stock. The fundamentals look terrific. What's the problem with the story? Well, Qualcomm is very strongly coupled to handheld mobile phones that's their number one market. Anything that is wireless, Qualcomm is very good at it. And they do have a military business, by the way, because obviously the military uses wireless technology. And they are getting into laptops. They have a chip, the Snapdragon chip, that's getting into laptops. They manage power very efficiently with their devices. It's pretty impressive. And their laptops, I think you can have a laptop with the Snapdragon chip and not have to plug it in for days. And that's pretty neat. And the business, $43 billion revenue business, PE ratios are really low. I mean, we're talking about a semiconductor company. When I show you their profit margins, you'll see that, yeah, they in fact are a technology business. They pay dividend at 2.14%. Now let's take a look at their business. Their business is growing. It's a pretty large business at $43 billion in revenue. And give me a second here. You there, Daryl?
Yes, I am. My internet is still acting up a bit.
No problem. And
We'll
all right,
see what
great.
we can get through here today.
And share your screen when you get a chance. That way we can pop over to your screen when you're ready to go. All right, so their revenue is growing at 15%, and they're a big company, so that's a pretty good clip. Looking at the quarterly, you're seeing very good green numbers across the quarters. So the story isn't helping Qualcomm because what's missing is they're not in the data center. And the data center is where all the excitement is, right? No big surprise to anybody. the data center is growing so darn fast and it's getting so much capital, and Qualcomm is kind of on the outside looking in. It's that's just the reality. But the fundamentals are looking good. Very good growth. They have terrific gross margins. Free cash flow, they're a cash flow generating machine with an upward trend on cash flow. That looks great. And gross margins 55%. They design these chips and then they just mass produce them. This is the classic, mass produce the same item, sell it to as many customers as possible, and you make lots of money to the extent of 26.77% profit margin, 26.87% free cash flow yield. Those are terrific fundamentals. And that's what it attracts me to Qualcomm. It's like, hey, this is kind of a forgotten, underestimated stock. And some analysts agree with that statement. We're at $165 per share, and some analysts think it's worth $225 a share. Other analysts believe it's worth $140. Now, the downside isn't too bad. From 164 to 140 isn't all that bad, but you got good upside, and you have that dividend involved. When we look at a forecast of the years to come, we've got a good growth year that's happening. It looks like they just ended their fiscal year yesterday, September 30th, 2025, and they were expected to grow at 14, which is in fact happening. They're going to slow grow for a couple of years if I believe these analysts. I have no reason not to believe them, so I'm going to go with it. So you're going to be a slow grower going forward. That looks okay. And then earnings per share is going to expand over the next 3 years. So really, the stock price is in Qualcomm's hands. If they could overachieve on this growth number, we're going to get some positive action on the stock price. We're going to see this stock price continue to go higher. If we see slow growth like this, this is not going to be a sensational stock. It's just going to exist. It's going to go up maybe slightly. It's going to come down a little bit. Either direction, it's not going to be all that dramatic. It's just going to be small moves, in my opinion. So that's an interesting forecast to look at within Qualcomm. All right, I'll wrap up my side of the story here by looking at their valuation. And here is Qualcomm. Now, I had an 8% growth rate, but we just looked at that growth rate together, and it wasn't 8%. It was, less than that. So I'm going to change it to 5%. So on the fly, I'm kind of changing my valuation, and I'm going to get rid of these fields because they're unnecessary. When I do that with a discount rate of 8%, I didn't cover the balance sheet on Qualcomm because I'm very familiar with their balance sheet. It's a very good balance sheet. But any other stock that I'm not familiar with, I look at their balance sheet just to make sure I'm not looking at a company that has too much debt. And since Qualcomm is a very good cash flow generating company, their cash flows are worth $330 billion. You see that they have a lot of cash on hand, almost enough to pay off all debt. So when I add cash, take away debt, they get to an equity value of $329 billion, well above their current stock price. So long term, this is a winner for me. I'm an owner of Qualcomm. I buy over time. I think I've done well in semiconductor. It's been one of those industries where now I missed on Nvidia, so I kind of failed the final exam of semiconductor, so to speak. But I hit on Broadcom. I did great with TSM. I made a lot of money on TSM. I'm in Qualcomm. It's not quite been a winner yet. I bought into ASML here in 2025. It's doing great. So I like semiconductor, and I feel like this one is going to reward me over time. So I'm going to continue to buy shares. When I take a very conservative approach on PE, they are a growing business. It provides a discount, and my blended discount is 39%. So I actually disagree with the analysts. The analysts are quite conservative, and I think it's the story that's weighing on them that Qualcomm's not in the data center. So they're not inside the call it the nightclub that everybody wants to get into. They're outside waiting to try to get inside the nightclub. Well, who cares about the nightclub? I care about fundamentals. I want to see cash flows. I want to see growth on top line. I want to see a very well-run business, and that's what I'm getting out of Qualcomm. All right, so that's my fundamental review on Qualcomm. You want to show us the charts there, Daryl?
Yeah, so on the 14th of September, I posted in the Discord that we had a 13-week and a 65-day swing high. And we also have a small cup with handle here. And at that point, I calculated that it would run up to about 174, but it would face resistance there, which it actually reached that target that I posted. I think I had 173 in the Discord, so it actually surpassed that target by about $1. And now it's starting to roll over, but we were in an upward trend. We had come down and tested the bottom of that trend that was set back from April the 7th, and now we're just trading below the midpoint in that 6-month trend channel or so. So I thought I'd cover that one because I did post it in the Discord 2 or 3 weeks ago where I thought my target would be, and it looks like it hit it within $1. So the next one, you want to go to the next one?
Yeah, so that was quick on Qualcomm, huh?
Yeah, I can show you the cup and handle specifically.
No problem. Yeah, you want to move on
So
to Nvidia now, or?
yeah,
Oh,
let's
okay.
do Nvidia. So I now have a price target of 204 to 208 on Nvidia by year end. I'm basing, by the way, they hit a 4.5 trillion market cap yesterday.
Incredible.
This price will put them over 5. But the reason, I have 2 reasons why I'm putting this target on here. We had another cup with handle after a long grind higher. We had a little pullback. If you measure the depth of that cup and add it back, you'll get to about 204. And then if we go and look at the seasonality, in October, 62% of the time they're 3.7% higher. In November, they're 8.9% higher, 85% of the time. December, they drop a little bit. Then in January, over half the time, they're up another 5.2%. So this is a really strong season. And that's why I give them the price target of 204 to 208 by the end of the year. That's my thought on Nvidia.
Very good. Very good. All right. So let me take a look at Nvidia. I took a look at the stock market and was distracted.
Yeah.
All right. So Nvidia, incredible company, up to $4.5 trillion of market cap. It's just incredible rise, $165 billion of revenue. And the P ratio is 53 for the current year. It's going to drop to 32 next year. It's a strong buy with a 10% discount according to analysts. They're basing that on earnings per share. Year to date, it's up 38%. It's up 1.8% as I speak. The revenue growth has been stupendous, incredible. They keep in mind, 5 years ago, they were an $11 billion company. Today, as I speak, they're 165. Incredible. This is a massive business that has become so important to the economy, to the technology space. It's their GPUs that are really powering a lot of the AI development. So if that continues, I think I think Nvidia is going to stay a top, 3, top 5 most valuable business for a long time. It's going to have the experience that Apple's had. Apple stopped growing a while ago, and they're still one of the most valuable businesses because I think so many investors pretty much have stayed with the Apple stock for a long time. I think investors are going to stay with the Nvidia stock for a long time. And the revenue growth has been incredible. Their free cash flow is really, really incredible. They, again, over 5 years, they went from 4.2 billion in free cash flow generation to 72. And again, I refer to this often when we are looking at small caps. What kind of small caps am I looking for? I'm looking for revenue growth, and I'm looking for the ability to generate cash. Because when I look at the most valuable businesses, and I'm looking at the most valuable business in the world, they generate cash flow. That's what I'm looking for in small caps. I'm looking for the same recipe that is making Nvidia the most valuable stock in a small cap. So just wanted to point that out because that's why Nvidia is, man, it's incredible. Gross margins almost 70%. I think their volumes are beginning to, weigh down on the gross margin overall, but that's going to be fine. I think they're fine with the volumes that they're operating with. Profit margin of 52%. I mean, these guys are just printing money, just printing it. You got the US Mint prints money, and so does Nvidia. Forecast, and they have a terrific balance sheet. No need to worry about their balance sheet. So an analyst believes it can go to 250. Another analyst believes it can go down to 100. So there is probably a difference in opinion of how long this AI build out's going to last. If it lasts for the next 3 years, Nvidia is fine. If it starts to slow down drastically in the next 6 months, it's going to get interesting. I don't know which is going to happen. I don't know. I'm just going to keep a close eye on what's happening in the data center and then adjust my expectations accordingly. But for now, I think the data center is going to continue to be built out through 2026. I don't see what's going to slow it down, but we'll see. We'll see. So on average, analysts believe that there's a discount available at 10% on Nvidia. And when we look at their growth rate is going to slow down, right? These numbers are they're already staggering, but they're just going to get massive. And it's hard to keep growing, especially since semiconductor is a cyclical industry. And what that means is they have boom periods when they grow. Everybody buys all the semiconductors they need, and then it slows down. And data center is like that, right? The data centers are being built because customers demand the high performance compute. And if there comes a day when businesses are like, hey, we have all the compute we need, we don't need any more capacity, and there's a glut, there's excess capacity, that's what's going to cause a contraction in revenue. And if that were to happen, it's going to get interesting with Nvidia. I don't know what's going to happen to the stock price because, again, using Apple as an example, Apple hasn't been growing for the last 3-4 years. They claim victory when they grow like 4%. It's like 4%. That's survival growth. It's not, obviously Nvidia growth, 60%, 61%. So if they get down to slow growth, no growth, we'll see what the market does. But most definitely, if they were to start to see a forecast where, hey, our revenue is actually going to drop 25%, then it's really going to get interesting. But that's looking down the road a little too far. Profits are going to continue to expand nicely. That looks really good. So obviously, Nvidia has terrific numbers. Now, looking at my valuation of Nvidia, I think the stock's priced 27% too high. I think each share is worth $136 a share, and it's priced at $185. I am giving them a superb free cash flow forecast, just, an incredible cash forecast, but it can sustain, or I should say, it supports an incredible $2.6 trillion valuation. But the market can't get enough Nvidia stock, so they bought the stock, raised the price, and it's a $4.5 trillion market cap business. Now, this all makes logical sense when you think about giving it an example. I just bought an EV, and right now, timing is really makes a big difference. When I started looking at EVs, I would say about, I don't know, it's 6, 7, 8 years ago, EV prices were quite a bit higher, and there was a little bit of a premium because there wasn't that many, and it was kind of cool that, hey, I don't have to pay gasoline, and I'm in California where we have very high gasoline cost. They provided, some other perks as well. And fast forward, now there's plenty of EVs, and man, the discounts they were offering here in the month of September were incredible. It was like, wow, I've never seen discounts on cars like that. So I bought an EV. Now, Nvidia is really rare. And I think, for a couple of years, investors have just been piling in. I get it. I think it was the right move. I missed it. But I think at some point it's going to lose that type of shininess to the object, and we'll see how the stock handles it. It'll be interesting to see, and most definitely I'll be paying attention because it's the most valuable company in the world. The earnings per share, it does support their stock price, but I depend on this free cash flow. This is 66% of my valuation. So that's how I get to a stock price that's 27% below the current Nvidia price. Now, Nvidia is going to keep doing what it's doing. I'm going to keep doing what I'm doing. I'm doing great this year. I'm going to keep making money, and I'm going to stay in my lane. I make decisions, and a good part of my decision is looking at fundamental value, finding things that are discounted, buying them at the right time, making lots of money. And if Nvidia doesn't fit into that process, it doesn't get bought into my portfolio. So that is Nvidia. We are.
Let me show one more chart before we get off Nvidia. So I actually drew this chart in 2023 when I made my first purchase, and this was on this breakout. It's actually a long base breakout. Once it broke out, I bought at the end of December, and it ran up. Then it consolidated. We had another breakout. It consolidated. We had another breakout here after a long consolidation. We had another run up, and now we consolidated, and it is breaking out above here. So we'll continue to watch this chart and see if this breakout continues. But this is 4 different breakouts on this price. I followed 3 of them. I'm not, I still hold shares in Nvidia, but I'm just holding. I'm not adding to them here. But, if I really believe in my fundamentals, I probably should be adding some here.
Yeah, well, good deal that you own them. Congratulations on owning a real good winner. All right, so we've got some stocks that are being requested. We got a lot of people on the stream. Thanks everybody for joining. It's great to be with you on the first day of the fourth quarter of 2025. And this quarter is potentially going to be one for the ages, right? If we keep cranking along and maybe we end in the 20s, the 3-year run that we've been on, 23, 24, and 2025, I mean, that is called wealth expansion for those who invested in stocks. So we'll see if we keep cranking along. The next stock that was recommended by a viewer was Remitly Global. And I'm not familiar with this stock, so let's get familiar with it. And this company engages in the provision of digital financial services in the US, Canada, and internationally. It offers cross-border remittances, complementary financial services through mobile application and website. They started in 2011 and headquartered in Seattle. So this competes with Western Union and these companies that help primarily people that are working in the US or are in the US and are trying to send money to another person in another country. Here in the US, there's a lot of money going down to Mexico, as an example, also South America, where a person lives here and they have people they care about in those countries. So this has been a business that Western Union has, made money on for quite a while. These guys are down 28%. And for the 1 year, it's up 20%. 5 year, not a good picture. It looks like they IPO'd way back here in 2021. They really opened up high. So interesting. So this is a small cap, 3.37. Now, welcome to small cap, the world of small caps, right? You're going to see volatility. You're going to see stocks scream up and down. It's not Johnson & Johnson. So put on your chin strap if you're going to be investing in small caps, especially small caps that are growth related. Now, they're super rewarding. So if you do it right, it's worth it. But if you can't handle volatility, just be aware. Small caps are going to test you. They're going to test your mettle of, I was up on the stock 20%. Now I'm down 30%, that kind of action. So this stock here is a $3.37 billion market cap, revenues of $1.46 billion, PE ratio 260. Who do they think they are? Palantir? Anyway, so forward PE is 18.69 and they're discounted by 62%. Wow. Okay. What kind of growth are we looking at? Wow, that's pretty good growth. That's pretty good growth. 35%. You got my attention, Remitly, and it's consistent. Okay. You're going to keep my attention. Let's take a look at your margins and free cash flow. So cash flow is expanding. You see how they went from negative? That's the natural growth of a business, is they're small, they don't generate cash and so forth. But once they get scale and they have all things that they need to operate with, like platforms and systems, which is what they need, boom, time to make some cash. $346 million of free cash flow. Gross margins 59.6. And the gross margins are expanding. I like seeing that. As they get bigger, they'll continue to expand. I'm liking what I'm seeing here. So the free cash flow yield is 23%. They are slightly profitable. I think that's going to improve over time. Again, as they get scale, it's going to improve. So the stock isn't bid up. Let's take a peek at their balance sheet. This is a small business. Their balance sheet has to be good. No exceptions. 515 mil of cash, only 32 mil of debt. So yeah, the balance sheet is superb. They can pay off debt immediately. So that looks good. What are analysts thinking? We got 11 analysts. They all think the stock market doesn't understand this business. It is valued far higher. All analysts have a price target above the current stock price, which is why collectively, on average, they think it's 62% discounted. They're going to keep growing year after year. They're going to become a more than $2 billion revenue company, earning a very good margin, generating very good cash. So these guys have my attention. Now, I want to take a look at their website just to get familiar with who they are, what they're about. So this is Remitly. Okay. Let's take a peek at their website. Yep. Yeah, I understand this. And I was traveling down in Mexico City, and I was down there for a while, and I needed to have some money sent to me. And I used the service, and I forgot what service we used, but I ended up going to a Walmart, and picking up my funds. So I had that experience. I've never really sent money to somebody outside the country, but I understand. I mean, we're a global, I mean, the world is so small now when you consider how well connected we are that this should happen quite often. So it looks really good. This looks like a really good business. Let me turn it over to you. You can take a look at the charts, and then I'm going to start working on evaluation for Remitly.
Okay. So one of the things I see here is they went on quite a run here. And then they started to form a cup and handle, which would have been promising. But you'll notice they failed to create the handle on this cup. So that was a failed cup and handle there, even after they had this really good run. So that would have been a nice move if they would have come up and retested this edge. Then you could have had a pretty high calculated price target, but that failed. So keep that in mind when you're looking for these cup and handles. They can be forming and then not complete, so the pattern is invalid. I'm going to remove that annotation there. We can see that they are trading below a declining 200-day moving average. The 20-day just recently crossed below a 50-day, which is declining as well. And the 20-day is trading below that. And they are on pretty good downtrend. So let me go back up here and get to where we can put in a trend line. So I'll just I'll start here. So that's a pretty long trend line back from February, and even the shorter term trend, if I drew it from here to here, it would pretty much just align with this primary trend line. So what the price action is showing me is that you have higher or lower highs and you have lower lows. What'll be interesting to watch is to see if this breaks down below this prior low, or whether we can indeed turn around and break this negative trend and get back into a positive trend. The RSI is pretty low. Let me cancel out of the annotation. I'll save this in case we want to come back and look at it someday. The RSI is pretty low at 34. The PPO did a crossover on about the 9th of September and has not recovered since. The divergence between the 12-day and the 26-day moving average looks like it is getting a little bit smaller, so the momentum, let me think here. Yeah, the momentum is declining, but is slowing down a little bit. We had max accumulation over the last year at around June the 16th, and it's been in a steady sell-off ever since. We have money flows that are negative since June, and let's see, it's outperformed the S&P by 3.82% over the last year, pretty much even with the financial sector. It's outperforming its industry group, specialty finance, by 11.7%. And that industry group overall is underperforming the S&P 500. So my inclination, despite the fundamentals being so positive on this one, I would have to wait for this to stop declining before I would consider pulling the trigger and owning any shares. And that's my personal thoughts on this one from a technical perspective.
You know, and And on that note, I would say that, investing, it takes qualitative decisions. It takes judgment calls. And I respect like your analysis and your conclusion totally. And I see that your thoughts and your opinions are substantiated by analysis. At the same time, for an investor, we're looking for things that are mispriced, they're misclassified. Somebody has it wrong. Either the market has it wrong or the market has it right. And I believe they have it wrong on Remitly. And it's going to potentially take a while for the market to realize it. But if Remitly continues to grow at the rates they're growing, they continue to crank out that cash, it's not going to be ignored forever. In fact, it's 68% discounted. It's the cash. I'm glad we looked at Nvidia and I showed how awesome their cash flow was. I'm glad we looked at J&J. Now, J&J has been around for 100 years, and that's not an exaggeration. They've probably been around for 100 years. And it took them a while to get up to that cash flow run rate. Nvidia, it really cranked out cash very quickly. But I want to focus on what makes those companies worth hundreds of billions, and in the case of Nvidia, more than $4 trillion. It's that cash. So I'm finding cash here. Rally produces cash, and they're growing. Analysts expect they're going to grow. So that is a formulation that I think is going to be worth a lot. Now, if the market decides, hey, we're not going to pay attention to Remitly, just going to let it operate, so be it. But this is a very good stock for me to consider buying. For me, I classify this as a buy. Now, I don't buy immediately. I like to sleep on it. I like to think about it, beat it up a little bit, and then come back to my analysis and rethink it all over again and then make a decision. But I really like what I'm seeing. They have a ton of cash on the balance sheet with no debt. They have very little profitability, which is fine because earnings per share, this is not even considered by many investors. This is the number that most investors look at, is the cash flow value of a company. And it looks stupendous, combined 68% discount. So Remitly looks great from a fundamental perspective, and the market just doesn't like it. I think the market may be hanging on a story that's come out, which is stable coins within the crypto space could become a network that becomes highly used and a better way to send money around the world, because you're on a network and it's going to be sent at the speed of light. Okay, I get that. But the adoption rate, I'm a crypto investor. I'm not a crypto hater. I'm actually started buying cryptocurrencies in 2017, 2018. So I was early. But the adoption, I think, is underestimated. If people think, oh yeah, you're going to have people that are going to be sending money potentially to somebody in another country that isn't very technology savvy, the adoption rate's going to be really slow for stable coins. And I think companies like Remitly, if they're doing something right and growing at the rates that they're growing, I think it's a really, really good situation for this small cap. Small caps are going to be volatile, but are going to reward investors handsomely. All right, Remitly, good suggestion out there. Let's move on to the next stock. The next stock is DCTH, Delcath Systems. This company rings a bell. Delcath Systems, an interventional oncology company, focuses on the treatment of primary and metastatic liver cancers in the United States and Europe. The company's lead product candidate is Hepzato Kit. You guys can tell I didn't make it through biology very well in high school or college. I didn't take biology in college. I knew what was good for me. So this is a med device company, healthcare. All right. So med device, they're down 7% over the 1 year. Doing okay, 23%. Not good over the 5 year. Okay. Market cap, really small cap, 385. Revenue, 70 million. P ratio is really high, both for the current year and next year. We'll see how they're growing. Strong buy, very discounted. Wow. These are, so it looks like they had been working on the development of their product, testing it, getting it FDA validated, approved, and so forth. And boom, they made it to market. So why isn't the stock just screaming up? They're growing 70%. So that looks okay. It's trending higher quarter over quarter. So this is a young business. Let's see what their margins and so forth look like. So they are cranking out a little cash flow. Gross margins are stupendous. 85% is very, very good. And the profit margin, they do have profit already, 3%. Okay. Balance sheet, super important for a company like this. So the balance sheet, they have less than $1 million of debt, and they have $81 million of cash. So they have a net cash balance of 80 million, and they're producing free cash flow. Very, very good. Why do I say that about this company? And maybe I wouldn't be as stressed out about it over a pure play software company. These guys are manufacturing a device, meaning they have to pay for materials, cash, pay for labor to make that product, that item, cash, put that item as a finished good into inventory, cash is sitting on the shelf, cash. So if they had debt, I would feel concerned, but I'm not, because they're generating free cash flow. All those things are now not a big concern. So think about that as you think about your businesses that you're looking to invest, is how much cash does that business need? If they're a pure play intellectual property company, they don't need a lot of cash. They just need better ideas. They need to write that code, get it to market, sell as much as you can. But if, let's say, you're making an automobile, easy for us to get our heads around that. You got to buy all the materials, tires, motors, third party, original equipment that's going to go on that vehicle. That consumes so much cash in your supply chain that you need a war chest of cash just to operate. It's less desirable business. So that's why I really look at the balance sheet. And that's what goes off in my head when I'm looking at that balance sheet. So this is a small cap, very small. 4 analysts are covering. They think it's really discounted, that this business is worth a lot more. And, this potentially could be worth a lot more. Let's look at the forecast. So they're going to grow and become a $200 million company in 2028. The profitability, everything looks good. If an investor is confident in this business, this is a good idea. The other thing that we need to keep an eye on is that the healthcare space has not been, embraced by investors. It's kind of been sold off. I think this stock is a discounted stock. I think it's going to do well eventually if they continue to grow that top line. Their profitability is there. I just don't know when the market's going to start buying it, which leads me to turning this over to Daryl to weigh in on what the markets are doing with this stock.
It's a pretty volatile stock. If you look at where my crosshair is currently sitting and then look to the left on that horizontal line, you can see that the current price has acted both as resistance and support over the last year. So it looks like this price is where the support is. It is trading below. It looks like the 200-day has started to decline, so it is below that. The 20-day had been declining for about 5 or 6 days. It looks like as of today, it has turned back upward, but it's up 4%, 3.5% today. And it had been trading for the last 4 days below a downward sloping 50-day, but did cross above that. The 50-day is still declining. The RSI is right at the midpoint. PPO is right at the midpoint. Accumulation, it's actually been in distribution mode since the 19th of May after reaching peak accumulation. You can see that the money flow is currently negative. They have outperformed the S&P 500 by 8%, outperformed the healthcare sector by 33.84%. Medical equipment industry, they've outperformed that by 22%, but that industry overall is underperforming the S&P 500. Once again, if I drew a downtrend line, you can see it's right at that downtrend. So it wouldn't take very much to break this. If it can break above that trend line and start on somewhat of an upward bearish reversal, then that would be a good thing to see. But it's pretty much sitting right there.
Very interesting. Really small cap. I mean, I wouldn't be surprised if that becomes a super winner, but it's going to take a little while. The market. All right. So it looks like Meta. What's going on? The stock market is not liking Meta today. It's down 2.71%. That's probably the biggest big cap loser. Google's down. Nvidia's down a bit. Microsoft's down. Walmart's down. Interesting. And then energy, the big oil companies are down. Netflix is down. Is this the I'm trying to figure out why are these stocks down so much? I know that President Trump announced that there would be a tariff on movies that were not made in the US. I don't know how that would affect Meta. That might affect Netflix, right? Because if Netflix is in essence, showing a movie was made in another country and they have to pay 100% tariff, that could be an impact. But I don't think Meta shows any movies. Google, ditto. I don't think Google shows any. I don't know. A mystery on October 1. All right, moving along. We've got the next stock that was requested, Alexandria Real Estate Equities, ARE. This is a real estate investment trust, and they actually do commercial real estate for biotech, pharmaceutical companies that need laboratory facilities. So it could be either a new young company that's like, no, we don't want to build a whole building and so forth. We just want to lease out the right commercial space and then, operate our business. Or it could be a bigger company that's like, hey, instead of us putting out capital to start that new research center in Cambridge, Massachusetts, let's go over to Alexandria, lease out some of their space. We'll put our scientists there. They can do their thing and we're good to go. So this is a very useful real estate investment trust. Their stock has not been doing well. this is rational in my mind because if you look at healthcare, it's been getting sold off for the last couple of years. So the healthcare space, hasn't been getting a lot of love. And obviously, like technology, the data center, and so forth, they are um, they are getting all the capital and all the attention. So the healthcare space is kind of beaten down, and it's showing up with this real estate investment trust that focuses on providing commercial properties to the healthcare space. These guys have a $14 billion market cap, and they pay a dividend. Look at that dividend, 6.37. That's a pretty good looking dividend. Now let's take a look at their financials. They have been growing their revenues. Look at that, green across the board, slowing down a bit, but it's still green. So that looks good. Now, when it comes to real estate investment trust, I don't use cash flows because they set up, these companies, they have a lot of hard assets. They own properties. They're going to carry debt because they have to own these properties. And the debt is, in essence, they leverage all these hard assets, these properties, and get debt against them. That makes sense. That's just their business model, which is why they have interest expense and so forth. So I actually look at their dividend and make sure that they could afford the dividend and look at earnings per share. So these guys, let's look at earnings per share. They've been losing some money. They were profitable before, but now they're losing some money. I wonder why. What has been weighing down their profits? So they had an asset write down. So the healthcare space isn't doing great. So they had to write down some assets. That's a non-cash item. Okay. So it's not a big deal. It could be a big deal, but I would guess that it's not a meaningful deal. All right. So analysts, they think, hey, stock market, you're missing out on Alexandria. It's discounted by 27%. And they're doing this on earnings per share. I'm not going to debate this. I think they're right. This is discounted because they're profitable. They're going to be profitable in 2026. Looks good. So I'm going to agree with this valuation. Now I'm going to look at their dividend. And when it comes to real estate investment trust, you want to look at the funds from operations. Funds from operations is what they produce, and they have to pay out a certain percentage or they lose their classification as a real estate investment trust. Looks like they've been paying $1.32 recently, and they're paying out. So they're paying out quarterly. So combined, this is going to be $5.28. Funds from operations, $7.72. They can afford that dividend. Okay. Plenty of money. So this stock's a pretty good idea. You got a high dividend. They could afford the dividend. They're growing their business. Now, healthcare has had, call it 2, going on 3 bad years. How many more bad years is healthcare going to have? I'm just betting the opposite, which is, well, they're probably not going to have like a 20-year, losing streak. They had a couple bad years. It's got to start picking up at some point, especially since some of these companies are coming up with great drugs and they're really becoming big success stories. So I think Alexandria is a great idea for the right investor. Now, what kind of investor would buy Alexandria? For what I suggest is for my 25-year-old son. No. I want you to go find the next Meta. I want you to go find the next Robinhood or the next Palantir. You focus on growth. But let's say an older investor that's like, I like income. I like stability. I like companies that are going to be around for the next 20 years. This is the right cup of tea for that person. This is the right cup of tea for that investor. So that would be where I would classify this. Alexandria being a really good stock for that income investor to consider. Do your homework and good luck with Alexandria. What do you think, sir, about Alexandria?
Real estate is something that I own a lot of. One of the things that I notice here is when the Fed started cutting rates last September, so a year ago, they cut them through December, and then we went on pause. So most of the real estate investment trust got back to near their highs in September when the market started anticipating rate cuts. And then they kind of went on hold after December. And then we had the tariff announcements, and then we've had the healthcare issues. So that's really hit on this stock. I'm going to look at a couple of other real estate investment trusts, because you'll notice these ADC is nearly back at its all-time high, or not all-time high, but where it was in September. So it dropped a bunch when the interest rates went on pause, but it's only about $4 away from the highs that we saw last September. Let's look at O, Realty Income. You can see that they're pretty much exactly where they were last September. So with rate cuts still being anticipated, I expect these real estate investment trusts to increase their price. So
Yep.
we can see that Realty Income is back to where it was. You can look at MPW, which is not one I recommend holding, but we were sitting at 563 and we're trading at 521, so we're only 40 cents away from the high that we saw last year. And then one other one I'll look at is Vici, and it got to 3204 last September, and you can see that its price is actually better than it was a year ago. So now I'm going to come back to ARE with that all in mind. They are really not anywhere close. They are 30% lower than their high in September. So this one is taking somewhat of a hit compared to the other real estate investment trusts that we just looked at, to a tune of about 30% compared to what they should be doing, other than it being specifically in healthcare.
Interesting. All right. So we've got a lot of chat activity going on. And thanks to the chat, I've been hearing stuff around Meta. Meta's down 2.5%. And they're acquiring a chip designer. I think it's Rebos. And that's significant news. But geez, man, these guys have so much cash. I wonder what the Rebos deal includes. Is it like a big acquisition? We'll take a look. So Meta down 2.77. Interesting. It's still, I think, having a decent year, 22%, 25%. And look at the fundamentals on Meta are very, very good. PE of 25.95. They say they're very good because you're going to see their growth. It's very good. Forward P is 25. So right now, if you want to buy growth, you have to pay up, and not with Meta. You're buying a growing business that has supreme cash flow, supreme margins, 82% gross margins, profit margins of 40%. Wow. That's really impressive. And so So you have these fundamentals that are just so good. And you're paying a PE ratio that is, I'm going to say, with the average of the S&P. So it's like, geez, man, that seems like a good deal. In fact, that's why I own so much darn Meta. It's the number one holding that I have. So growth, 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 growth in the future. They're going to be a $300 billion revenue company making 40% profit margin. So 300 times 40% is $120 billion of profit. Not bad for a year's work. That's incredible. And their free cash flow yield is really, really incredible. Having said that, I mean, I don't know why the market's selling off the stock. I have a nice discount on the stock. It's probably gotten better because, when you have a price decrease like that, of course, the discount's going to get better. I have Meta discounted at 30%. Now, earlier this year, if I was asked, hey, would you buy Meta or Google? I would have probably said Google. But you asked me that question today, it would be Meta. Meta is offering a nice discount. This is kind of back to Johnson & Johnson. We know what Johnson & Johnson is going to do. They're just going to keep being Johnson & Johnson, cranking out all that cash. Their products are a staple. I have the same feeling about Meta. Nobody's going to stop using Facebook. Nobody's going to stop using Instagram. They're just going to keep getting bigger, more profitable. I own a lot of Meta stock. I'm not buying any more shares because I'm trying to keep a balanced portfolio to some extent. I'm okay with Meta being so valuable and pretty much being probably a little too much. But I see other famous investors and they carry certain stocks and they carry a big balance of it. David Tepper being one of them. He had like 20% of his portfolio in Alibaba. And that's a big portion. I mean, that guy has hundreds of billions or tens of billions in his portfolio. I think he has a couple $100 billion in his portfolio. So yeah, I can carry Meta as a big position. But if I did not have so many shares of Meta, I would be buying this stock today. I would be buying it because market is having a hiccup and I'm going to take advantage of it. What do you think of Meta? What's going on at the Meta chart land?
Well, as of today, they're trading back where they were on February the 14th. They are trading above an upward sloping 200. They dropped below their upward sloping 50-day about 4 days ago. The 20-day was increasing, but it looks to be decreasing at the moment. Their RSI is starting to get pretty low. This indicates it's getting near oversold territory. The PPO is negative, but the momentum between the two moving averages is actually increasing, so it's getting worse today. The accumulation distribution has been pretty flat for the last since May of last year. So it's oscillated around where I have my cursor crosshair set, which has been oscillating around there. We can see that in the money flow as well. We've had positive and negative money flow just oscillating around there. This will be interesting to watch for, a breakout across these two price points from February to today. They've outperformed the S&P by 53.8, outperformed communication sector by 31%. They're in the internet industry group. They've outperformed that by 21, and that group has outperformed the S&P 500 by 26.44%. So they seem to be quiescing here at the moment. We'll just have to see if they can break above that, or whether they come down and test that 200-day moving average, which they do on occasion.
And I've been contemplating getting the Meta glasses, the Ray-Ban partnership, where I hear good things. They're like $800, but you wear glasses and they're basically connected to your Wi-Fi, and you can ask for a search, you can do different things with it. So I'm gonna see if I want to buy those beginning of 2026, because my health slash vision care plan, I can get 2 different frames per year. And I actually looked at them when I got a new set of glasses not too long ago, and I wasn't quite ready to do it, but maybe this go around. I wonder how people will feel if I have glasses with cameras on them. They might be a little uncomfortable with that. Like, whoa, everything's being recorded when I'm in front of this guy. But maybe I won't wear them around people like that. I'll just be like, hey, I'm out for a walk with my wife and near the shoreline, and I just wanted to capture the moment. Boom, Meta glasses. All right, enough Meta. Let's talk about Catalyst. Up 9.64% on the announcement that they're going to use all that cash on the balance sheet and buy back some shares. Now, another stock that I own, United Therapeutics, it was like a combination, like a Mike Tyson combination, a jab with a really, really powerful right hand to the market, because United Therapeutics bought back shares. And then they announced that a drug that they've been working on had very positive trials and very good conclusions. And the stock just jumped up like a lot, like 30% in a day. So, not saying it's going to happen on this occasion, but hey, Catalyst is going to buy back shares. They see that their stock is a little discounted. It has been selling off. These guys have had a very good 5-year, but the stock's been selling off, and they have plenty of cash on the balance sheet. They've got $652 million of cash. They have no debt. So it's like, yeah, buy back your shares. That's a very good idea. That's a CFO thinking about it and knowing what to do in this situation. Buying back those shares, and this isn't a giant company, $2.6 billion in market cap. They have 122 million shares outstanding. So if you're going to buy 200 million of your shares, just doing some quick math, I think that's about 8% of your shares. So that means that owners of the stock, like myself, my ownership of the company is going to go up by 8%. That's a good deal. That's good. That's a very good move. Now, if they can have a Mike Tyson combo, this is the jab, and then they come back with some positive news after they buy back shares, that would be great. But I don't know. That was wonderful with United Therapeutics. We'll see if it happens here. And in Catalyst Pharma, let's look at their forecast. I wanted to look at their forecast. Analysts love the stock, discounted by 54%, but I want to look at their forecast. This is a very profitable company. We're going to look at their profits in a bit. They're going to keep growing. This is good growth, and they're getting, more substantial. They have about 3 primary drugs. All 3 are under patent. One of them has probably been out there for a little while. One of them is like brand new patent, just going to be around for a while. And then they acquired a third that is still under patent. So this company is going to continue to thrive. And look at this PE is going to drop so low, but maybe this buyback is going to grab the market's attention, and they're going to look at Catalyst, or maybe a bigger company is going to come around and say, hey, we'd like to acquire you because you're only $2.6 billion in market cap, and we can buy you and buy those free cash flows and buy your growth, all those things we like, and you're discounted by 52%. So we'd like to acquire you. Thank you very much. And of course, they'd pay a nice premium. I would be happy. I'm already sitting on a gain with Catalyst. These are small caps. These are, they go up and down quite a bit, but on a day like this, it's pretty fun to see it rise almost 10%. Any thoughts on Catalyst Pharma?
While you were talking, I put on a 2-year trend channel. It did fall out of this trend channel back in July, and then got back in within the trend channel and then fell out once more. So this is 2 years worth of data where it stayed within a certain trend. Today's action is going to get them a little bit closer to moving back in that trend channel, which would be really good news. Today's action took the RSI from about 42 to 64. The PPO has been negative. The difference between the two moving averages on the PPO is increasing. So this momentum should probably carry over for a few days. The accumulation has been pretty flat up until the 5th of June when distribution kicked in. Money flows are negative. They have outperformed the S&P by 18%, outperformed the healthcare industry by 63%, outperformed pharmaceuticals by 64%, while pharmaceutical industry has underperformed the S&P 500 overall by 28%. So they're looking pretty good. It looks like they could move back into the trend channel, which would be good news after a couple months of weakness.
Yeah, we'll see how it goes. I'm going to hold my shares. I'm not buying any more shares because I do own a pretty good position of the stock. All right, so we have more requests that have come in. So the next one we're going to talk about is Deckers. And I was right in the middle of updating their valuation, but let me turn my attention to their fundamentals. Deckers is a smaller footwear company, and they have a pretty interesting history. They're headquartered in Santa Barbara, California, a beautiful place. And long time ago, the guy who started the company, they only sold sandals. They had this particular sandal, and I guess the shoe was called a Decker or something. And over the time, they've acquired certain brands that have been really hits. Like they had UGG boots, and more recently, they have those the shoe that is really comfortable. What is that name? Hoka. So the Hoka with a lot of cushioning, and people love that shoe. My wife's got a pair. She's got 2 pair, so she really likes them. So, and that's really changed kind of like the footwear industry. I know Nike's coming out with one. Adidas has got one now because people like that comfort. So they're doing real well with that. Now, Deckers had a really nice growth trend and the stock flourished, and then it fell off a cliff. So is it a good time to consider Deckers? Well, let's take a look. $15 billion market cap, revenue of $5 billion. PE ratio looks pretty darn good. 15, 37% discount. It's all going to be about growth. Growth is really good. 15%, 16% on the latest quarter. 15% is good. Revenue is $5 billion. This is not the biggest company in the world. Their shoes tend to be priced higher than like Nike, Adidas, because Nike, Adidas, they sell to the masses, right? So you can probably find a nice pair of tennis shoes for a low price. But when it comes to Decker stuff, like the Hokas are expensive, and they command that price. People want to buy Hokas or UGG boots or whatever they're buying. So their growth looks really good. Let's take a look at their margins. So their gross margins 57. I believe that's better than Nike. And their profit margins 19. That's very good. Free cash flow yield 17. Very good. So they have good fundamentals. Let's take a look at their balance sheet. See if they have any problems there. And the answer is no. They have 1.7 billion in cash and 312 million dollars in debt. So they can pay off debt immediately. They'd write a big check, but they have the money in the bank to pay it. So that looks excellent. Excellent balance sheet. good growth, good margins for an apparel company. Analyst, 19 of them. And the worst case scenario analyst is the downside risk isn't too bad. $87 a share. The stock's trading at 101. And the best case analyst is like, hey, you can double your money on this stock. On average, the stock is discounted by 37%. The growth is going to persist for the next couple of years. That looks really good. And their profitability is going to expand. So the numbers look really good with Deckers. Really, really good. Can I turn it over to you to look at the charts, and I'm going to work on my valuation for Deckers?
Yeah, let me save these annotations here. So the first thing I'm looking at, this is weekly data over the past 20 years. And I drew a trend channel. I like to look at long-term trend channels for these kind of companies, because several of them have fallen out of their trend channels pretty severely here recently. Deckers, at first glance, when I was only looking at 1 year daily, this was looking pretty rough. But after I drew the 20-year trend channel, they basically only fallen down to the midpoint of their 20-year trend. So that's looking a lot better than it did at first glance. And that's why it's good to zoom out sometimes and get a better picture than when you're looking a little narrower range. Now, the slope of this line over 3 years is 71.9%. So if you divide that by 3, that'll give you the annual price change CAGR for this particular holding. So I've saved that one. I'm going to go back to 1 year daily. And it's trading below a downward sloping 200. So the 200-day peaked out back in February. So it's declining. The 50-day is increasing after bottoming out in August. And the 20-day is currently downward sloping and looks like it's heading to cross below the 50-day moving average. So once again, if I was looking at this chart just initially, it wouldn't look very good. But then once you zoom out, like the 20-year weekly trend, it doesn't look as bad as it might at first glance. So the RSI is low. It's sitting at 27, meaning it's oversold. The PPO is in negative territory. The momentum looks to be decreasing to the downside at the moment. Looks like the accumulation and distribution has been cycling. We are at pretty much a 52-week low, maybe a low since March, but that's where we are there. The money flow is negative at the moment. They've underperformed the S&P. They've underperformed discretionary. They have they have underperformed footwear. That is the industry group. Yep. And footwear has underperformed. So it's no doubt they're underperforming at the moment, but keep in mind that long-term trend channel, which puts things in a little better perspective if this is a company you're interested in.
Yeah, very good. So let me see if I can get my Google Sheet to work properly. I finished the evaluation, but my lookups are not active. But I guess I'm gonna have to give you from memory, because I did look at it and then it stopped working on me. So I did a full valuation on Deckers, and it's discounted by 37%. That was the number. And it's also discounted on earnings per share. Now, Google provides this free Google Sheet with these really cool lookups. It's not looking up right now. So I've hit refresh 3 times, and I'm betting that it's not going to work this time around. It's probably mad that its stock price is being sold off. But all kidding aside, it's a discounted stock, and it's not a bad idea. This is a growing business. It's an apparel business. Not my favorite, but I think these guys are a little different because they have a higher sale price on their product. I think they make better margins. So I'm going to be watching this stock, and I might buy it. Don't own any apparel. Not the first industry that I would want to buy, but it's not a bad stock to hold as a diversification play. I think it's going to do well over time. Their shoes really are a big hit. They know how to get the right shoes to market. It's not an overly, oversold category like our friends at Nike. I think their problem is they can't get any bigger because they've sold a pair of Nikes to everybody on earth. And it's like, who else do we sell Nikes to? So
I've never owned a pair of Nikes.
Well, like, there you go. You're part of the addressable market they can go after next.
No, I don't think they'll ever address me.
So these guys, not a bad situation. It's set up quite well. You see that the stock was probably a little overheated up here, but now the market's playing it safe. Okay. So Deckers is not a bad idea. I think it's a good idea. Speaking of shoes and the opportunity for Nike to sell one more pair to Daryl, let's talk about Nike. What's going on? So Nike Land is very happy. 5.65% rise in the stock. And frankly, I looked at their earnings yesterday and I was not impressed. This stock has not been a good stock for 5 years. It's not been a good stock for 1 year. The PE ratios, we just looked at Deckers at 15, and these guys are at 37, and they're not growing. Well, I'd rather buy Deckers. I'm probably going to repeat that, by the way. I'd rather buy Deckers a couple of times. And look at this. Ugly. And then, boy, they're throwing a party. They're growing by 1%. You don't throw a party when you grow 1%. You breathe a sigh of relief and you go, I think we're going to survive. That's more of the tone that I would put on it. Now, it's good news that they're not going to contract anymore. That is encouraging, but they're not out of the woods. It's like, guys, you were losing revenue for a reason, right? Maybe the consumer is shifted. Now, I would say I'm going to go back 20 years, maybe 30, and say, boy, like, Michael Jordan was such an influence. He still is, but back then it just seemed like everybody had to have cool sneakers, and the cool ones were from Nike. And I don't know that is as strong anymore. I think that sports is great, but I think we get media from all sorts of places. For example, you and I are doing a live stream, and I think consumers of media now are on YouTube, they're on TikTok, they're on all these different things, and their eyeballs are away from sports or commercials that are promoting a lot of these brands like Nike. So I don't know that this trend that we have seen Nike take is going to go away. I think they're going to have a hard time growing. It's like, you guys sell shoes, right? And Hoka is $5 billion in revenue. Deckers is $5 billion in revenue. These guys are 46. It's hard to grow when you're that big. Their profitability is 41%. Deckers was way better. It was in the 50s. Free cash flow has been going down. Well, Deckers, it's been going up. So Deckers is really, from a metric perspective, better than these guys in every way. Deckers was nearly at 20% profit margin, 20% free cash flow yield. It's like, why would I buy Nike? I wouldn't be making a good decision. I'd rather buy Deckers. Deckers is giving me a better opportunity as an investor. So Nike, I thought their earnings were not very good. I don't understand why the market's buying it up. And even the management team was like, hey, we managed to grow a little bit, but we're very concerned about next year. And the market's trading the stock up. So that is interesting. Maybe because it's been sold off, but so has Deckers. It's been sold off quite a bit. These guys have been on a long-term sell-off, though. Deckers did have a really nice rise and then a drop. So if it was between Nike and Deckers, you know where I would go. I'd strap on some Hoka shoes and buy the Deckers stock. Although if you looked at my closet, I own a lot of Nike sneakers. In fact, I need a new pair of sneakers, and I'm not going to wear a pair of Hokas. It just doesn't go with my style, so to speak. It'll be a new pair of Nikes or probably a new pair of Adidas. Although I was thinking of going Puma. You know, remember Puma, that brand out of Germany? They have that kind of different direction swoosh. Okay, so this is not an apparel channel. This is an investing channel. We're not going to give out, thank God, I'm not going to give out any fashion tips. I am going to talk about stocks and see what the heck the stock market's doing on the first day of October. Looks like Nvidia has caught a nice bid. It's up in the green now. Meta's still in the doghouse. The universe is not liking something about Meta today. And we talked about that stock at length. We've talked about Google quite a bit, and it's down today. We talked about Google over the last couple of weeks, I should say. Palantir is doing nice rise today. Micron's up really well. This whole space here, and I bought ASML earlier this year. Man, I'm so glad I bought it. And you know, I would love to see your charts on ASML. Would you mind showing ASML? Because
Sure.
that stock, I bought it and it felt like I was like I went through Europe, right? And the train system in Europe is fantastic, and it's on a schedule. And we would get on a train; it'd be a high-speed train, and we'd get there with like 3 to 5 minutes to spare, and then boom, we're going at 100 miles an hour. And I thought, wow, that's how I feel about ASML. It's like I bought the stock, and then boom, it's going 100 miles an hour. What are you seeing on ASML?
This is Deckers. Let me wrap up with Deckers. I have this auto support resistance line here, which is over 2 years. The downside risk is actually pretty small, I think, at this point, using this auto support resistance. So if you're looking to buy, this is probably a pretty low risk time to do it. ASML, let's take a look and see what we have there. I'm going to go out to 1 year. They're looking pretty good at the moment. Let me step out a little bit. So they're not quite back to their high, but they're definitely working to get there. Their high was in July of 2024, at least over this 3-year period, where they looks like they closed at $1,064. So let's go back to a year now. They're trading above an upward sloping 20, 50, and 200-day moving average. They're all in the correct order. They've had quite a few gap ups in this ascension of the price here. The RSI is overbought, sitting at 80. That's actually a pretty high RSI, so might be running out of breath here pretty soon. The PPO looks like it's getting ready to turn over and give us a bearish crossover in bullish territory. Money flow is positive. Accumulation looks like it's at a 52-week high. On a daily chart, it's in the upper right-hand quadrant of the relative rotation graph. It's outperformed the S&P by only 3.82% this year, over the past year. It has nope, it's underperforming technology sector by 5.89%. It's underperforming its industry group, but that industry group overall is outperforming. So this is some curious price action considering it's in line with the S&P and underperforming its industry group. Looks pretty strong over the
Yeah.
last month.
And when I talk about ASML, like if you ever want a nearly perfect example of a company that has a very strong moat, study ASML. They make these giant machines that make semiconductors. There's one company on earth that makes that machine, ASML. So the companies that the foundries like TSM and Nvidia, not Nvidia, Intel that run their own foundry, when they buy those machines, they have one place to go, ASML. So it's a very, very strong moat. And the stock, it presented a nice opportunity here. This is where I bought, and it just took off on me. And I've been buying shares as often as I can. I loaded up. This has been an accelerated buy for me. And the fundamentals just really look good. It's a big cap, 376 billion. PEs are kind of high, but when you look at the growth, this is a big business growing at 26%. That's really good. And they have good margins, good cash, good balance sheet. And when I look at the valuation of ASML, it's a 6%, as I speak, 6% discounted stock. I would buy ASML stock today. And because of that moat, that moat isn't going to go away. And we're going to make more semiconductors in the future. So ASML has got a very, very strong place in the future. And ASML has been a good stock to pick up this year. And I'm glad I did so. So, all right. So let's go ahead and wrap things up. This was a great stream. Thanks, Daryl. Really appreciate it.
Quite welcome.
And everybody, we are not going to stream together on Friday. And we're going to stream together again on Monday, I think, and Wednesday, Friday of next week. Look for notice on when we're going to stream. But Friday, Daryl can't make it. No big deal. We'll catch up with him next week. And I'll stream again probably tomorrow evening, and then look to see if I could stream on Friday. We will see. It'll be a game time decision on Friday. Everybody, good luck with your investments here in Q4. Go ahead.
If you don't mind, let's look at one chart for Nike, because you kept saying you'd rather buy Decker over Nike at the current moment, even though you're a personal buyer of Nike products. This is a 20-year trend channel, so I showed one for Decker.
Wow.
Here's one for Nike. So for 20 years, they were pretty much, showing really good growth. And they fell out of that channel on the 19th. And if you draw a trend line across here, they don't show any signs of breaking out of this downward trend. And this 20-year, they just have not gotten anywhere close to. It should be a $200 a share stock right now if it was going to stay in this trend channel.
And in my story on them, it's somewhat like the narrative matches the chart, which is how are they going to grow? That's going to be hard. It's like, hey, their brand isn't as well, the brand value isn't as high as it used to be. All those things to me are like big factors that are supporting your chart.
Yeah. So I drew this chart back probably at the beginning of the year, because I can tell by where I have my Fibonacci retracement level that it was probably right around here where I drew that. So after basically 6 months later, I mean, they haven't even retraced 32% of this downward price spiral from whenever I had this set to the top. Yeah. So it's been 5 or 6 years, 5 years at least. And they haven't even recovered 32% of that downward price decline.
Thanks.
So that supports what you were saying, Victor.
Yeah. Well, thanks for sharing that. All right. Well, that wraps it up, everybody. Again, good luck with your investments here in the Q4. Let's lock in some of those gains and let's keep figuring out which stocks are really good buys and which stocks are not. We'll stream as often as we can. Thanks so much, everybody, for tuning in. Thanks for all the chat today. And thank you, Daryl. Appreciate it. Hope you have a good day.
Thank you, Victor. It was good to be here, and thank you, everyone. Good to see you all.
All right. Take care, everyone.